Most of us have used Fibonacci retracement at least once or twice in our trading. It is one of the most popular tools traders use to analyze market structure and price movements. It can provide valuable insights across different assets and timeframes, helping traders identify potential support and resistance areas, trend continuation zones, possible reversals, and even signs of trend exhaustion. Recently, I came across a Fibonacci-based indicator that completely caught my attention. In this video, I'm going to show you exactly how it works, and the best part, we'll be testing it live on the Bitcoin chart to see how its signals would have performed over a series of historical setups. Make sure you stick around until the end, and let's get started. First, head over to the Indicators tab on your TradingView and search for ATR Fibonacci trend envelopes created by Big Beluga. Once you add it to your chart, it will appear with its default settings. At first glance, it looks similar to a traditional Fibonacci, although you'll notice it only displays 4 key levels. Double-click on the indicator to open the settings. Under the Inputs tab, you'll see several options that control how the indicator behaves. These settings can be adjusted depending on the asset and timeframe you're analyzing. Different markets can respond differently. Below that, you'll find additional settings. One interesting thing about this indicator is that it's built around the multi-timeframe framework. It pulls data from 4 different timeframes to help provide a broader view of market conditions. If you move over to the Styles tab, there isn't much that needs changing. Most of the visual settings are completely optional and come down to personal preference. What makes this indicator different is that it's a dynamic Fibonacci tool rather than a traditional static one. It combines the volatility measurement of the average true range with Fibonacci calculations to highlight areas where price may react during an existing trend. These areas are called pocket zones. Well, that might sound a little complicated, but it's actually very straightforward once you see it in action. These highlighted zones, or pockets, act as areas where traders may pay close attention. In an uptrend, they can represent potential support zones, while on a downtrend, they can represent potential resistance zones. Another feature I really like is that the indicator projects these levels forward on the chart, leaving a space ahead of current price action. This projection can help traders visualize potential areas of interest and plan their trades more effectively. Let me show you an example. In this case, price moves lower and enters the pocket zone. Since this area is being identified as a potential support zone, some traders may watch for signs that buyers are stepping in and that the existing uptrend could continue. Now let's look at the opposite scenario. Here, price rallies into a pocket zone that is acting as a potential dynamic resistance area. When price reaches a zone like this, traders often become more alert because it can be an area where sellers may start showing interest again. In this example, price begins moving lower after reaching the zone. Later, it rallies back into the same resistance area, reacts once more, and then continues moving in the direction of the broader downtrend. And of course, no indicator can predict market movements with certainty, but these zones can provide useful areas to monitor when analyzing trend continuation and potential market reactions. So let's build a simple trading setup around this indicator. The first thing we're going to focus on is trend continuation, because that's one of the easiest and most straightforward ways to use this tool. In this example, you can see price finding support within the pocket zone. That is the first clue that the existing uptrend may still be intact. If we look at the multi-timeframe dashboard, we can see 3 bullish signals. Having multiple timeframes aligned in the same direction can add context to the overall market structure, especially when one of those signals comes from a higher timeframe, such as 4-hour chart. Then when price breaks above the zone, some traders may view that as a potential entry trigger, depending on their trading plan and confirmation criteria. Now let's look at a bearish example. In this chart, price is repeatedly facing resistance within the pocket zone. We can also see several failed attempts to break higher, suggesting that selling pressure has been stronger than buying pressure. If we check the multi-timeframe dashboard, we once again have 3 aligned signals, but this time they are bearish. This adds further context to the downside bias being shown on the chart. Then when price breaks below the zone, some traders may consider that as a potential short trade trigger, provided it fits their strategy and risk management rules. Well, the key idea here is not to predict what the market will do next, but to use the combination of the pocket zones, price action, and multi-timeframe confirmation to identify areas where trend continuation may be more likely and then manage risks accordingly. The second way to use this indicator is by looking for trend reversals, situations where the market shifts direction and begins forming a new trend. In this example, price moves lower and breaks below the zone. Shortly after, the indicator changes color, turns red, and moves above the candles. This implies that bearish conditions are strengthening and that momentum may be shifting to the downside. If we also check the multi-timeframe dashboard, we can see 4 bearish signals showing a strong alignment across all tracked timeframes. As the chart develops, price continues moving lower, and we can clearly see a transition from a bullish market structure into a bearish one. Now let's look at the final example before we move on to the backtesting section. Here, price starts moving towards the zone and eventually breaks above it. At the same time, the indicator turns blue and shifts below the candles, that the momentum is beginning to favor the upside. When we check the multi-timeframe dashboard, we see 2 bullish signals and 2 bearish ones. At first glance, they might seem mixed, but the bullish signals are coming from the higher timeframes, the 1-hour and the 4-hour charts. Some traders place more weight on higher timeframe signals because they can reflect the broader market trend. After the breakout, price accelerates higher and begins forming a new upward move. Then partway through the trend, price pulls back towards the zone, which is now acting as a support instead of resistance. For traders following the trend continuation approach we discussed earlier, that pullback into support could have been another area of interest to watch for potential re-entry, always using their own confirmation rules and risk management plan. The time has come to put this indicator to the test on Bitcoin. But before we jump into the backtesting, don't forget to subscribe and leave a like if you've learned something new from this video. Also, feel free to join our Telegram channel for additional educational content, market analysis, and news updates. You'll find the link in the description below. Now let's get into the backtest. We're looking at Bitcoin on the 2-hour time frame. What's interesting is that I haven't even changed a single setting on the indicator. Everything is running with the default configuration, and at least from this historical review, it appears to be performing quite well. Starting with the most recent setup, we can see a breakout below the zone. Following that move, price continued lower. Along the way, price retraced back into the zone, which was acting as a resistance, and the downtrend continued until reaching the live market area at the time this video was recorded. If we scroll back a little further, we can see another example where price pulled back into the zone during an uptrend and found support. This would have been a trend continuation scenario based on the rules we discussed earlier. Going back once again, we can spot a breakout above the zone supported by several strong candles. In this case, price transitioned from a bearish structure into bullish one, giving us a reversal setup. Moving further back, we find another reversal signal. This one is particularly interesting because the initial breakout didn't immediately follow through. The candles were relatively weak, and price didn't move lower right away. However, the indicator had already turned red, suggesting that bearish momentum was potentially building. As the chart developed, price rallied back into the resistance zone, where it was rejected before continuing lower. Looking back, this ended up becoming a solid trend continuation setup. We can actually find another similar situation before this trade. Once again, the breakout wasn't clean, and there was a possibility that traders could have been caught on the wrong side of the market initially. Even so, the indicator was signaling a potential momentum shift. It had turned blue and moved below the candles. Before wrapping up, I want to mention something important. No indicator should be used on its own when making trading decisions. Indicators can be useful tools for market analysis, but they can also produce false signals and perform differently under changing market conditions. Historical examples are useful for learning how a strategy works, but they don't guarantee future results. And before you leave, I have to announce that I'm not a financial advisor, and this is not a financial advice. All content, information, and opinions shared in this video are for educational and entertainment purpose only.